Hi, let us understand margins in future trading. So, what is margin? Let us consider that if you want to buy a stock, using the normal method, you have to pay the full amount for the stock. Suppose if the price of a stock is 100 rupees and you want to buy 1000 stocks, it will be about 10,000 rupees to buy 1000 stock. However, in case of futures trading, suppose if you buy the futures of that particular stock with a lot equivalent to 1000 stock, then you will not pay the complete 10,000 rupees amount, but you will pay only a portion of that amount. So that portion of that amount is called as margin. So margin is extensively used in future trading, and that is the advantages of the trading in futures, because it will help you get the leverage by taking the same quantity of a particular stock or an index future by paying 40 to 50% or half the amount what is required to buy the entire portfolio. So how is a margin calculation done for a stock in futures trading? It can be a stock or it can be an index. In calculating the margins, the Indian Clearing Corporation, that is National Clearing Corporation of India Limited, there are this clearing corporation. They used a very sophisticated risk-based margining system called as span margin system. So this will help them to analyze how much margin which is required to be set for a particular stock or a particular index. See, we have to consider that margin is calculated based on the volatility of a stock. What is the volatility of the stock over a period? The period can be one day, the period can be 6 months, or the period can be 1 year. So, based on this volatility of a stock, the margin is generally calculated. Now, what happens once the margin is calculated? Every day, the futures is marked to the market. It means if the future price, is suppose a person has taken a position in the future market at a particular price of 100, and if the future price goes to 105 rupees, then the Clearing Corporation of India take give 5 rupees to the individual who is taken a long position. So the 5 rupees, where does it come from? It come from a person who has taken a short position, because that person has lost 5 rupees, and a person who has taken a long position has gained 5 rupees because the future price has gone from 100 rupees to 105 rupees. So this is known as marking to market daily basis by the Clearing Corporation of India Limited. So this will help to ensure that all position are adequately collateralized throughout their life of the contract. So what are the different types of margin? Let us understand different types of margin which is there. The first one is the initial margin. What is initial margin? Initial margin is the amount of margin we need to give to the clearing corporation based on the standard portfolio analysis methodology uh, set by the Clearing Corporation of India Limited. So this is the upfront margin we have to give whenever you take a position in the futures. See, this initial margin is typically about 10 to 40% of the contract value, depending upon the volatility. As I have already told you, if the volatility is less, the margin amount will be less, and if the volatility is high, the margin amount will be high. Similarly, if the liquidity is very high, then the margin amount will be less. But if the liquidity is less, then the margin amount will be accordingly, higher. So the next is the exposure margin. Exposure margin is the additional margin which is collected as a percentage of the contract value. What is contract value? Let us consider a stock Reliance whose one lot is equal to 500. It means 500 shares of Reliance will be one lot. So if the price of the Reliance is 10 rupees, let us assume for the time being, so the total contract value will be 500 into 10, which is typically 5000. So Exposure margin, which is an additional margin, is calculated as a percentage, that is 3 to 5% of the contract value. This will give an additional buffer against any potential losses. And we have to assume, we have to understand that initial margin is calculated based upon the volatility. So it is a statistical measure. Sometimes black swan event may occur. What is a black swan event? See, the statistical measure is, suppose if there is two standard deviation or three standard deviation. Based on that, the margin, initial margin is calculated. Sometimes, if the market volatility will be higher than the 2 sigma, that is 2 standard deviation, then this exposure margin will come into effect. So this will act as a cushion for the span margin. Now we have something called as extreme loss margin, ELM. So what is extreme loss margin? Extreme loss margin is basically charged on the short position, which is equivalent to 0.5% of the notional value for index option. So if you are taking a position in the Nifty 50 index, so it will be 0.5% of the notional value of the index option, and 1% for the stock option. If you are taking any short position in the Reliance, so the notional value of the whatever is the position which you have taken, so 1% of which will be considered as an extreme loss margin. So this will protect against the tail risk scenarios not captured by the standard risk model. That's what I was telling. If the volatility goes beyond 2 standard deviation on either side, then extreme loss margin will come into play. Mark to market margin is nothing but the daily settlement of profit and loss based on the closing prices, which I have already explained now. So here losses are immediately debited to a account where an account has taken a short or long position depending upon the movement of the future price, and profits are credited, ensuring that the positions remain adequately margined at all times. Now let us understand what is a span margin. Span full form is Standard Portfolio Analysis of Risk. See, this is a very sophisticated margining methodology. We will understand how this span margin is calculated in the coming slides. So this was developed by a Chicago Mercantile Exchange, and it is adopted by not only Indian exchanges and exchanges all over the world. What does it do? It calculates the largest potential loss a portfolio might suffer over a specified time horizon. That's what I said. So it is a standard, a statistical measure. It calculates the largest potential loss a portfolio must suffer, or it might suffer over a specified time horizon. The time horizon can be 1 day, the time horizon can be 1 month, or whatever it is. Here, the system evaluates 16 different scenarios combining the price movements with volatility. What does it mean? So, based on the volatility, whatever the price movement which is happening, those 16 different scenario price movements are calculated. Whether the price is moving up or down by one third range, that is 33.3% up or down, and similarly volatility changes happening, which is calculated by a fixed percentage based on the historical volatility of a particular stock or an index. So if a historical volatility of a Reliance is for the past 5 years is around max is around 7%, so this volatility changes is calculated based on up and down by a 7%. So this identifies the maximum loss across all scenarios, and this will set as the margin requirement. We will see an example of this. So this is a risk-based approach, and it ensures adequate protection while optimizing your capital efficiency. So based on the 16 different scenario, in this 16 different scenario, whichever the maximum loss happening for a particular combination of volatility and the price, that will be taken as the margin requirement. So what are these key span parameters? First one is the price scan range. It measures extreme price movements, as I have explained. And there is volatility scan range. It captures implied volatility changes happening. See, implied volatility is nothing but the volatility implied by the movement of the price of a particular stock or an index. And then inter-month spread. No, actually it recognizes correlation between contract months. What does it mean? Suppose Reliance, is having future contract for 1 month also. It is having contract for 3 months also. It is having a contract for 6 months also. So how well the correlation is happening between the 1 month contract, 3 months contract, and 6 months contract? This will be calculated, and based on that intermonth spread calculation, span margin is analyzed and set. Now, let us understand, convergence of future price to spot price. So, how this convergence of future price and spot price happens? What is convergence? It nothing but a phenomenon where future price gradually move towards the spot price at the end of the contract. As the contract termination approaches, the future price and spot price usually converge and become equal. So, at the end of the expiry date, the future price must equal the spot price. Otherwise, arbitrage opportunities would exist that the traders would immediately exploit. Okay. See here, we can see at the start of the contract, the future price is equal to the spot price plus cost of carry. What is cost of carry? It is nothing but the cost of holding a future contract. Let us assume if you are holding a futures, contract of a particular index. So since index has, you have to purchase the any index, you need money for that purchasing a particular, futures in the index. How do you get this money? Either you can buy this money from somebody, or you buy this money from the bank and then invest. Let us assume if the risk free rate of interest is RF, then this RF will be the cost of carry. Similarly, let us assume that you are holding a futures in a commodity. Suppose if the commodity is wheat, then you have to hold. If you are holding a short position in wheat, that means you are planning to sell wheat. It means you have to hold the wheat till the time you sell the wheat. So the holding of the wheat may require cost of warehousing, cost of insurance, cost of you have to protect the your commodity from fire and other hazards and theft. So all these incur some cost, and that is called as the cost of carry. So initially, future price will be equal to the spot price plus the cost of carry, and later as the time elapses from 0 to t, where t is the time at which the contract is going to terminate, the future price will keep varying from the spot price. So this variation of the future price from the spot price at on any particular day or at any particular point of time t is known as the cost basis or deviation. So this basis oblique deviation will happen when the future price moves from starting point 0 time 0 to time capital T. So but at the end of T, the settlement, the future price should be equal to this. So whatever is the spot price which is there at the point of time T, that is S capital T is the spot price available, whatever the spot price which is there at time T. So let us assume that if the future price trade above a particular fair value, what does the arbitrager do? The arbitrager will sell the future and buy the spot, and they earn risk-free profit. If future trade below the fair value, then they buy future and short the spot. So these activities generally push the future prices equivalent to the spot price at the termination of the contract. When is the contract terminating? At capital T. This capital T can be 1 month, capital T can be 3 months, and it can be 6 months. So how does this convergence happen? Let us see. See, when you start, as I have already explained, future price will be equal to spot price plus cost of carry, where cost of carry will be interest cost minus the dividends. In case if you are holding a financial, futures or a stock, but if you are holding commodity, then the cost of carry will be cost of warehousing, cost of insurance, cost of theft, and all those things that will come as a cost of carry. What is the basis? The basis is the difference between the future and spot price, and this basis will be widest early in the contract when carrying costs have maximum time to accumulate. It means when you start a futures contract at time 0, and as soon as the future contract starts moving, the basis will be the difference between future and spot price will be high, because the cost of carry will be high. During the mid contract period, what happens? The cost of carry components start decreasing proportionately. It is quite obvious. At any point of time, somebody is taking a future position after 50% of the contract has elapsed. The cost of carry will accordingly reduce by 50%, right? So the future prices gradually approaches the spot price. Those significant basis may remain due to remaining time value and anticipated dividends. What does it mean? We will understand that. See what happens, the future price of a particular stock can move towards the spot price, even though there is a difference between the futures and spot price. But why it is significant? Because of the time value which is there and the dividends which are anticipated from a particular stocks. I am talking about the financial future contracts here. Suppose if you are holding stock, then you may anticipate dividends out of it. So, if you are anticipating dividend and if there is enough time value, then the future difference between the future and spot price will be generally high. So, when you near expiration, the cost of carry become negligible, and arbitrage forces, as I have just explained, intensify, as any price discrepancy will offer lossless profit, or no costless profit or easy profit for the arbitragers. So future and spot price begin tracking each other very closely at the end of the contract. On the expiry day, generally, the future will settle at the spot price or whatever is the official settlement price. Whatever the difference which is there is eliminated through the settlement mechanism, ensuring complete convergence by the contract end. It means at the end of the day, or the end of the cost expiration day, the future must settle equal to the spot price. Or if it is not settling, there will be some official settlement price which will be determined, and based on that official settlement price, the any difference between the spot price and the future price will be eliminated. Now we will come and understand what is cost of carry model. See, let us understand what is a cost of carry model. See, cost of carry provides a theoretical framework. It provides a theoretical framework for futures pricing, and it explains the convergence phenomena. Cost of carry always try to explain the convergence phenomena happening between a spot price and a future price. It tries to establish a fair value relationship between the future and spot price based on financing cost and benefits of holding the underlying asset. If there is some benefit of holding an underlying asset, okay, then also the cost of carry may decrease, because that is called as the convenience yield. We will understand what is a convenience yield in our future slides. See, cost of carry represents the difference between the cost of maintaining the position and any income generated from the asset during that particular period of time. Let us assume you are holding a futures contract, okay, of Reliance. And during the period of holding the futures contract, if the Reliance, declares dividend, which will be given only in during the period of you holding a contract, then that income which is generated by that financial asset or that asset during the time of the holding of the contract will have a direct impact on the cost of carry. So, what are the components of the cost of carry? There are three core components. One is the storage cost. See, storage cost is generally applicable to commodities, as I have already explained, like gold and oil, wheat. It includes warehousing cost, insurance, and security. And second is opportunity cost. See, what is an opportunity cost? It is nothing but, suppose if you borrow money to acquire an asset, you have to pay interest to the bank. So, if you use your own money, you are holding, then you lose the interest which you would have got by putting that money in the bank. That is called as an opportunity cost. And finally, you may derive income through dividends or through convenience yield. What is a convenience yield? Suppose you are holding copper, let us assume, 1 quintal of copper, and immediately there will be scarcity of copper for the next 1 month. Then your copper will be in very high demand from the manufacturers, whoever wants this copper for their production. That benefit you will get by holding copper prices when there is shortage of copper in the market is known as the convenience yield. So convenience yield in case of a stock is dividend from the stock, or in case of bonds it can be interest from the bonds. These are all this will come as a income. So let us understand the futures price pattern. There are basic two future price pattern. One is contango and another is backwardation. These are all very complex words, but they are very, very simple. See, contango is nothing but when the future prices are higher than the spot price, it is called as a contango. Usually, the future prices for a contract with an expiration of 6 months will be higher compared to a future price of a contract with an expiration of 1 month or 3 months. So, this pattern of the future price being greater than the spot price reflect the cost of carry relationship. That is why whenever the future period of future is very high, 6 months or 3 months, the cost of carry will be generally high, as a result of which the future price will be higher than the spot price at any particular point of time. Because why? The future prices has to incorporate storage cost, financing charges and insurance expenses, which is generally associated with holding a physical commodity. See, contango a, is very, very common with non-perishable commodities with storage cost, and for the financial assets where the cost of financing exceeds the dividend which you are receiving. Okay, if the dividend yield is 2% and if the cost of risk-free interest rate is 5%, then generally if you are taking a long position in a financial asset, the future price will always be higher than the spot price. That is why it will have a contango effect. So the premium of futures over spot compensates holders for carrying the asset until the expiration of the contract date. See, this contango concept provides opportunities for arbitrageurs and influencers who are who can execute some hedging strategies for the portfolios which they are holding. Now coming to backwardation. What is backwardation? It is just the opposite of contango. Backwardation occurs when future prices trade below the current spot prices, creating an inverted price curve where near contracts are more expensive than the distant ones. See, this is a totally different thing happening. Usually, futures price should be higher than the spot price because of the cost of carry model. However, in case of backwardation, the future price will be less than the spot price, or the near term contracts, that is, suppose a future contract of 1 month will be costlier than the future contract for 6 months. This backwardation can only happen whenever there is a shortage or when there is a immediate increase in demand. Suppose if there is a supply shortage for a particular raw material, then that particular commodity will have backwardation where the spot price will be higher than the future price. Similarly, if a bond uh, is in high demand, then the backwardation can still happen because the near term interest rate for the bond will be higher than the long term interest rate given for the bonds. So in backwardation, what's going to happen? The market generally places a premium on immediate availability. So holders of physical inventory will earn a convenience yield. That's what I explained what is a convenience yield. by maintaining stocks for immediate sale. So this yield exceeds the cost of storage and financing, making it profitable to hold physical assets rather than the future contracts. What does it mean? Suppose if an item is in heavy demand, it makes more sense to hold a physical item rather than holding a future contract, because that item is in demand. So you know, if you sell those item which is in high demand today, you will earn more profit than holding a future contract for next 6 months. That's what this sentence is trying to imply. So why backwardation happen? Backwardation happens whenever there is a temporary supply disruptions or shortage, and also seasonal demand peaks exceeding the supply which is being there, and whenever there is high convenience yield of physical holdings happen.